Welcome to the Explainer. Today, we're going to draw a really clear line in the sand, the line between actually building wealth and just gambling with your money. And to do that, we're going to use the timeless wisdom of the father of value investing himself, Benjamin Graham, to answer one absolutely critical question.
So let's just cut right to the chase. Are you an investor or are you a speculator? Now, it sounds like a simple question, right? But it's one that most people, even those who've been in the market for years, have a really tough time answering honestly.
And look, here's the uncomfortable truth. A huge majority of people who think they're investing are, in fact, speculating. And this isn't just about labels or semantics. Trust me, which side of this line you land on has massive, and I mean massive consequences for your financial future.
Okay, so how do we find that line? For that, we turn to Benjamin Graham. See, he didn't leave this open to interpretation. He created a super clear, three-part test that really is the ultimate standard for what counts as a real investment.
Here it is, straight from the source. This definition, it's so simple, but wow, is it powerful? Every single word in there matters. You'll notice it says nothing about getting rich quick or 10-bagger returns. He calls it a disciplined operation. So let's break that down.
So this is the heart of it, right? It's a three-part checklist. First, thorough analysis. That means you've actually studied the business, not just the squiggly line of its stock chart. Second, safety of principle. That means you have a rational reason to believe you won't lose your shirt. And third, adequate return. You're looking for a reasonable, solid gain, not a Powerball jackpot. And here's the kicker. If you miss even one of these three, Graham is crystal clear. You're speculating.
All right, so if that's investing, what does the other side of the coin, speculation, actually look like out in the wild? Well, let's look at 4 super common traps that fail Graham's test every single time.
This table just lays it out so perfectly. Buying a stock just because it's going up, that's momentum chasing, and it completely throws thorough analysis out the window. What about acting on a hot tip you got from a friend or some guy on YouTube? You have no idea what their agenda is. It's not your analysis. Piling into some hot new IPO, you have almost zero historical data to know if the price is even remotely sane. And finally, buying stuff like meme stocks or NFTs, just hoping a greater fool will come along and pay more, your entire thesis is based on crowd psychology, not actual fundamental value. Now, I know what you might be thinking, but wait, people got rich doing all of those things. And yeah, you're right, some people did. But Graham's whole point is that they got lucky, and they confused that luck with skill. See, speculation can pay off sometimes, but it's not a system. It's not repeatable. Investing is. So once you decide, okay, I'm going to be a true investor, Graham says there are really 2 and only 2 valid ways to go about it. And the most important thing is figuring out which path is right for you. Let's put them side by side. The defensive investor, their number one goal is just to avoid huge mistakes. They use simple strategies like broad diversification, think index funds, and it takes minimal effort. And Graham was really clear on this. For the vast majority of people, this is the best path. Then you have the enterprising investor. Their goal is to actively hunt for specific, undervalued companies. This path demands maximum effort, endless research, and a very specific kind of temperament. And this is a warning you absolutely have to hear. Graham said that sort of dabbling in stock picking without the full-time commitment it requires is the absolute worst thing you can do. You get all the risk of the enterprising approach without putting in any of the hard work that's required to actually succeed at it. Okay, enough theory. Let's make this personal. We've gone through the ideas. Now it's time to apply them directly to what's in your account with one final, very powerful litmus test. So seriously, think about your portfolio right now. Every single stock, every fund, every asset you own, can you confidently, without hesitation, answer the next 3 questions for every single one of them? This is it, the moment of truth. Number 1, can you explain in simple terms how this business makes money? Number 2, do you have a logical, fact-based estimate of what it's actually worth based on its earnings and assets? And number 3, can you clearly explain why today's price is a bargain compared to that value? If you can't give a solid yes to all 3 for any single thing you own, you aren't investing in it. You're speculating. It's that simple. And that brings us to the final crucial thought. Look, it's okay to speculate with a small amount of money you're fully prepared to lose as long as you know that's what you're doing. Just don't ever confuse it with investing.
Because over the long haul, the market is a brutally honest referee, and it is incredibly good at separating the disciplined investors from the hopeful speculators. The only question left is, which one are you going to be?